The Zurich Axioms, the rules of risk and reward used by generations of Swiss bankers, is a classic book on speculation and risk management, first published in 1985 by Max Gunther. Gunther, an Anglo-American journalist and author, drew inspiration from his father, a Swiss banker, and a group of wealthy Swiss speculators known as the Zurich Gnomes. These individuals amassed fortunes through bold, calculated risks in markets ranging from stocks and commodities to art and real estate. The book's core message is contrarian. True wealth comes not from avoiding risk, but from embracing and managing it intelligently. Unlike traditional investment advice that emphasizes safety, diversification, and long-term holding, the Zurich Axioms promote speculation, betting on uncertain outcomes for potentially high rewards. Gunther argues that most people want gains without real bets, leading to mediocrity. The Swiss speculators succeeded by treating investing as an adventurous game, accepting worry as a sign of meaningful engagement. The book is structured around 12 major axioms, fundamental principles, and 16 minor axioms, supporting rules. These apply to any venture where money is risked for profit, not just financial markets. Gunther illustrates them with engaging stories, historical examples, like tulip mania, and personal anecdotes, making the book entertaining and accessible. While praised for its psychological insights into greed, hope, and fear, the axioms challenge conventional wisdom, e.g., no diversification, sell winners early. Critics, like trader Victor Niederhofer, call it overly simplistic or dangerous for long-term investors. However, it remains influential for speculators, traders, and entrepreneurs seeking high returns. Below is a detailed explanation of each major axiom, including its associated minor axioms, key concepts, examples, and rationale. Major Axiom 1. On risk. Worry is not a sickness, but a sign of health. If you are not worried, you are not risking enough. Risk is essential for significant rewards. A life without risk is secure, but boring and poor. Speculation requires venturing into uncertainty. Worry signals you're playing for meaningful stakes. Gunther contrasts adventurous speculators with cautious investors who prioritize sleep well at night portfolios. The Swiss thrived by accepting volatility. Minor axioms. Minor 1. Always play for meaningful stakes. Bet amounts that matter. Small, painless bets yield small gains. Minor 2. Resist the allure of diversification. Spreading bets dilutes potential wins. Focus on a few high-conviction opportunities. Put all your eggs in one basket and watch that basket. Minor 3. Sometimes grouped here. Accept that losses are part of the game. Example. 2 investors. One diversifies across 20 stocks. The other concentrates on 3 to 4. The concentrated portfolio may swing wildly, but has higher upside if picks are right. Major Axiom 2. On greed. Always take your profit too soon. Greed destroys wealth by holding winners too long, hoping for more. Sell when satisfied with gains, not at imagined peaks. Gunther warns against gambler's greed, letting profits ride until they evaporate. Minor axioms. Minor 3. Decide in advance what gain you want from a venture, and when you get it, get out. Related, avoid the fear of regret that comes from selling early. Example. A stock doubles. Greed says it'll triple. Often it reverses. Swiss speculators locked in profits systematically. Major Axiom 3. On hope. When the ship starts to sink, don't pray. Jump. Cut losses quickly. Hoping for recovery in losing positions is fatal. Accept defeat and exit. This counters hold and hope mentality. Minor axioms. Minor 4. Accept small losses cheerfully as a fact of life. Expect several while aiming for big wins. Minor 15. Never try to save a bad investment by averaging down, buying more at lower prices to reduce average cost. Example. A falling stock. Praying for rebound ties up capital. Jump early to preserve funds for better bets. Major Axiom 4. On forecasts. Human behavior cannot be predicted. Distrust anyone who claims to know the future, however dimly. No expert, economist, or analyst can reliably predict markets. Forecasts are guesses. Minor axioms. None directly, but ties to skepticism of news/gurus. Example. Countless wrong predictions, e.g., perpetual bull/bear calls. Speculate based on your analysis, not others' prophecies. Major Axiom 5, on patterns. Chaos is not dangerous until it begins to look orderly. Markets are chaotic. Avoid seeing illusory patterns or order where none exists. Minor Axioms. Minor 5, beware the historian's trap, assuming past events predict future identically. Minor 6, beware the chartist's illusion. Technical patterns like head and shoulders are coincidences. Minor 7, beware the gambler's fallacy. Streaks don't guarantee continuation/reversal. Example, chartists see patterns that work sometimes by chance, failing spectacularly otherwise. Major Axiom 6, on mobility. Avoid putting down roots. They impede your ability to move when needed. Stay flexible. Don't get emotionally attached to investments. Minor Axioms. Minor 8, don't cling to ventures out of loyalty or nostalgia. Minor 9, escape traps like sentiment. It's been good to me. Example, holding a family stock despite decline due to tradition. Roots hinder objective exits. Major Axiom 7, on intuition. A hunch can be trusted if it can be explained. Intuition is valuable, but only if backed by conscious reasoning, from experience/subconscious processing. Minor Axioms. Minor 10, test hunches logically. Discard unexplained feelings. Minor 11, never confuse hunch with wishful thinking. Example, a sudden gut feel about a stock. Trace it to overlooked facts, not mysticism. Major Axiom 8, on religion and the occult. It is unlikely that God's plan for the universe includes making you rich. Avoid superstition, astrology, or prayer and speculation. Rely on rational decisions. Minor Axioms. Minor 12, if astrology worked, all astrologers would be rich. General, optimism/pessimism from faith is unreliable. Example, investors timing trades by horoscopes lose to rational players. Major Axiom 9, on optimism and pessimism. Optimism means expecting the best, but confidence means knowing how you will handle the worst. Never make a move if you are merely optimistic. Pessimism, preparing for worst, beats blind optimism. No direct minors, but ties to risk management. Example, enter bets knowing exit plans for downside, not just upside dreams. Major Axiom 10, on consensus. Disregard the majority opinion. It is probably wrong. Crowds are often mistaken. Contrarianism has edge, but avoid automatic contrarianism. Minor Axioms. Minor 13, shun herd thinking, but don't oppose for opposition's sake. Minor 14, never follow speculative fads, e.g., hot sectors. Example, bubbles form on consensus, best buys when unpopular. Major Axiom 11, on stubbornness. If it doesn't pay off the first time, forget it. Don't double down on failures out of pride. No direct minors. Example, persisting with a wrong idea drains resources, move on. Major Axiom 12, on planning. Long-range plans engender the dangerous belief that the future is under control. Never take your own long-range plans seriously. Plans are illusions, stay adaptable. Minor Axioms. Minor 16, shun long-term investments. Predictability fades over time. Example, detailed 10-year forecasts fail. Adjust constantly to reality. Final thoughts and relevance for content creators. The Zurich Axioms promote a speculative mindset. High risk, high reward, psychologically disciplined. They suit short-term traders or bold entrepreneurs, but clash with buy-and-hold strategies, e.g., Warren Buffett style. For you as a content creator, this book offers rich material, provocative ideas for videos, posts, or series on mindset, psychology, and contrarian thinking. Discuss real-world applications, crypto booms/busts, meme stocks, or debates, axioms versus modern finance. The axioms remind us, wealth often rewards those who manage chaos, not avoid it. Luck plays a role, but discipline and risk separates winners.